If you're watching the insurance market in Colorado right now, this crisis isn't hypothetical. It's real. It's in your mailbox.
Oh, yeah.
We're seeing non-renewal spiking, especially in fire-prone areas, hail risk zones, and the premiums. I mean, if you can even find a policy, they are just skyrocketing.
And that pressure, that absolute crunch on consumer choice, it's
Yeah.
all driven by these relentless, severe weather events. It forced the state to step in. They had to create some kind of a safety valve.
And the safety valve is the Colorado Fair Plan. That's the Fair Access to Insurance Requirements Plan.
Right. It was established by legislation, HB 23-1288, signed into law last year. It's being sold as the last-ditch option, the state-mandated safety net for homeowners, for businesses who've been totally shut out of the traditional insurance market.
We call the admitted carriers.
Exactly.
A safety net. It sounds reassuring, but our deep dive into the source documents today, it reveals something really critical. If you don't understand the financial mechanics behind this,
Yeah,
this plan is not a net. It's a financial trap.
it really is.
Our mission today is to analyze the data, get into that fine print, and show you exactly why relying on the FAIR plan, even if you feel desperate, can lead to absolute financial devastation when you file a claim. And the whole danger, it just boils down to one simple, critical valuation method.
Let's start with the structure, because it's fully operational now. The Fair Plan Association Board was appointed, the Division of Insurance, the DOI, they approved the plan of operation on July 26, 2024.
So it's live. They're accepting applications.
They are. Residential and commercial. This is a working solution, but the financial ripple effects of it just existing are already staggering.
And this is where we start to see the real stress fractures in the market. The board approved a $36.5 million capital assessment.
Wow.
That's basically a bill that got sent to every single admitted insurance carrier writing property coverage in Colorado. They're the ones funding this safety net.
It's a huge number.
Yeah.
And it creates this fascinating tension, right? The major carriers, the ones who are simultaneously dropping policies because of risk, are also legally on the hook to bankroll the very plan designed to cover the risk they just shed.
And here's a critical detail.
Yeah.
That assessment does not apply to the surplus lines carriers.
Right. The non-admitted carrier.
Exactly. These are the companies that specialize in high-risk policies, and they get to stay completely outside the state's financial accountability loop for this whole safety net.
So why are people being pushed there in the first place?
It's simple, really. The admitted carriers are pulling back.
They're just retreating.
Our sources confirm a huge surge in non-renewal notices, and carriers have to give 60 days notice before that expiration. They are actively shedding policies based on these high-risk triggers, like location near the wildland-urban interface, a previous claim history, or just vulnerability to perils like those huge recurring hailstorms.
And the predictive technology they're using now, combined with the sheer severity of the weather, has made that traditional marketplace intensely selective. It's just smaller. And that selective nature means that for thousands of homeowners, the FAIR Plan is going to feel like the only door left open. But this is precisely where we have to deliver the warning. This transition from, a competitive traditional policy to the state's safety net, it involves accepting probably the most dangerous limitation possible in property insurance.
You're talking about actual cash value.
Exactly. The moment you sign a policy through the Colorado Fair Plan, you are accepting coverage that only pays out based on the actual cash value of your property.
Okay, we need to slow down right here and define ACV, because this is the single detail that bankrupts people after a total loss. What does the source material say?
ACV is formally defined as the replacement cost of the damaged item, less depreciation.
Less depreciation, that's the phrase that matters.
Everything. We cannot emphasize this enough. These policies are explicitly not replacement cost coverage, which is what almost every homeowner is used to having.
Let's make this real. Let's contrast these two ideas. Use a standard claim, maybe a big roof replacement after a hailstorm, under a standard replacement cost value RCV policy. If hail destroys your roof, the insurer pays the full cost to install a brand new roof at today's prices. Simple.
Right. But under the FAIR Plan's ACV structure, the math is completely different. Let's say your home is 20 years old and the estimated replacement cost for that roof today is $50,000.
Okay.
The FAIR Plan adjuster is going to look at the expected lifespan of that roof, let's call it 25 years, and they'll determine that 80% of its useful life has been depreciated based on its age and just normal wear and tear.
So 80% of $50,000.
Yeah.
That's $40,000 in depreciation.
Correct. And your payout is the replacement cost minus that depreciation. So 50,000 minus 40,000 leaves you with a check for just $10,000.
You're short $40,000 before a single shingle gets laid on your house.
And that difference comes directly out of your savings. It makes a full quality repair or replacement financially impossible for a lot of people, especially if they're already stressed about other things.
And in Colorado, this is not a theoretical problem. This ACV trap, it doesn't just apply to roofs. It applies to everything. Siding, furnaces, your kitchen cabinets.
Everything depreciates.
Exactly. This is why we call it a trap. It fulfills the legal requirement for your mortgage company, but it absolutely fails you, the homeowner, in the event of a major disaster.
And we haven't even gotten to the limits yet. They are also incredibly restrictive, especially in a high-cost rebuilding area like Denver or anywhere on the Front Range. For residential properties, the maximum combined coverage limit for the structure and your contents is only $750,000.
Wait. $750,000 for the structure and contents combined. Given current construction costs, post-disaster inflation, that barely covers a standard home rebuild in many of the areas hit hardest by wildfires. Is that really a safety net, or is it just a token offering to keep people barely afloat?
I think it's designed to provide access to coverage, not comprehensive protection. For homes in high-value areas, that limit is blown through immediately. You're massively underinsured even before you factor in the ACV depreciation.
And for commercial properties?
It's higher, $5 million. But that same ACV depreciation rule applies across the board.
Okay, so beyond the valuation and the limits, what about the scope of what's actually covered? The perils.
It's strictly basic. The core policy only covers losses from fire or lightning. That's it.
You can add things, though.
You do have options, yeah. You can purchase additional coverage for things like windstorms, hail, explosion, riot, vandalism, your standard stuff.
But the list of what's excluded is maybe even more telling. It shows what they absolutely will not cover, things that standard policies often do.
Exactly. The plan generally excludes critical protections like ordinance or law coverage.
Which is the money you need to update your property to modern building codes.
Right. It also excludes earth movement, water damage, power failure, neglect. I mean, if you have a total loss and the city then requires you to rebuild with new, expensive fire-resistant materials, the FAIR Plan's ACV payout covers zero of that code compliance increase.
So we've laid out the financial danger of ACV, the tight limits, the narrow scope of coverage. But the state specifically mandated this plan to be a last resort. You can't just walk in and sign up.
Correct.
You have to prove you've been rejected everywhere else. That's the barrier to entry.
That's it. The FAIR Plan is only available when coverage is, and I'm quoting, not available from admitted markets. This means you, the listener, have to demonstrate you've been rejected or refused coverage by private carriers. It's often called the diligent search requirement.
So the burden of proof is 100% on the homeowner.
100%.
You can't just take the first crazy high quote you get and decide the FAIR Plan is your only option. You have to exhaust the entire market first.
First, a diligent search means you have to be actively seeking out and trying to secure coverage. If you're unsuccessful with the admitted market, the big national and regional carriers, you should immediately contact DORA, the Division of Regulatory Agencies, for guidance.
Okay, and then?
Then, you absolutely must check into the surplus or non-admitted carriers.
And these non-admitted policies, they're often way more expensive than standard insurance, but they typically still offer full replacement cost coverage, right?
Precisely. They are more expensive, they operate under different regulations, but they offer vastly superior coverage compared to the FAIR Plan's ACV structure. You might pay $8,000 a year for RCV from a surplus carrier, but that is infinitely better than paying $3,000 for an ACV policy that leaves you $200,000 short after a fire.
So the FAIR Plan is truly the last resort before a forced place policy from your lender.
The absolute last resort.
This brings up a really interesting practical problem. When a major carrier hits you with a renewal quote that's double or triple what you paid last year, that feels like a rejection.
It does.
But it technically isn't. So how do you distinguish between being priced out of the market and being completely rejected by it?
That is the key question. We know carriers are over-indexing on risk. So before you settle for the FAIR Plan just because of a high premium, you need to confirm that that premium spike is actuarially accurate and unavoidable for your risk level. You need data to challenge that quote.
So what should you do?
Homeowners need to run their zip code through our Colorado Rate Analyzer tool just to see where they stand. You need to verify what reasonable premiums even look like in your risk zone before you just give up on the admitted market.
You can't just accept a price that feels punitive.
You have to arm yourself with market data and fight for full coverage.
That brings us perfectly to the types of coverage you should be fighting for in that private market, the crucial elements that ensure you're fully protected, which the FAIR Plan, as we've said, doesn't provide. And the good news is Colorado lawmakers, learning from the massive underinsurance crisis after the Marshall Fire, they've mandated new requirements effective January 1st, 2025.
And these new laws are essential. They mandate that agents must offer two key protections that directly fix the huge shortfalls we saw in recent years. These are the non-negotiables you have to secure.
The first one is all about inflation protection for rebuilding, right?
Yes. Agents must now offer a minimum of 50% extended replacement cost coverage, or ERC. If a wildfire wipes out 500 homes, the demand for contractors and materials just skyrockets. That inflation can make your original policy totally inadequate overnight.
But if your policy has 50% ERC, that coverage limit can expand to cover those unexpected post-disaster cost spikes.
It's non-negotiable protection in a state like Colorado.
And the second mandated coverage directly addresses that exclusion we flagged in the FAIR Plan, the cost of complying with modern building codes.
Right. Agents now have to offer 20% coverage for building code upgrades, or law and ordinance coverage. When you rebuild a home today that was built 30 years ago, you have to meet current codes for safety, for fire mitigation. That always adds significant cost.
So if your home has a $500,000 replacement value, that 20% gives you an extra $100,000 specifically for those mandatory upgrades.
And again, if you're on the FAIR Plan or any basic ACV policy, every single penny of those code upgrade costs comes straight out of your pocket.
Having those two things, ERC and law and ordinance, is the difference between surviving a disaster and facing total financial ruin.
And we also need to talk about loss of use, or ALE, additional living expense. This covers your temporary housing, your rent, while you're displaced. The rebuilding process takes years sometimes.
Colorado law requires agents to offer 24 months of ALE. But if you have the chance, you should really push for 36 months if you can get it.
Absolutely. After a major disaster, getting contractors, dealing with supply chains, rebuilding can easily stretch well beyond 2 years. That extra year of coverage is a vital cushion.
Which is why comprehensive comparison shopping can't just be about the bottom line premium.
No, you have to compare these specific figures: the percentage of ERC, the percentage of law and ordinance, and the duration of your ALE.
So how do you make that comparison effectively, especially if you're looking at multiple quotes from, admitted and surplus lines carriers?
This is why we've actually updated the comparison portal on the site with this new state-mandated data. You can easily plug in the policy details you're being offered and verify whether they meet or exceed the state requirements for ERC and law and ordinance. Don't just compare policy A's premium to policy B's premium. Compare the percentage of protection. That's where the real value is.
And finally, let's just briefly touch on mitigation. While carriers are dropping policies, it seems like proactive home hardening is the one piece of leverage a homeowner still have.
It absolutely is. It shifts the risk equation. Investing in ember-resistant screens, non-combustible siding, that data can be used to convince an insurer to reconsider a non-renewal.
Even the Fair Plan Board sees this.
They do. They're investing in tools to reflect mitigation efforts, which shows that even the safety net needs to incentivize risk reduction. Mitigation today is the surest path back into the preferred admitted market tomorrow, which, again, is always a superior financial move compared to settling for ACV.
So we're going to summarize the core takeaway for a homeowner in Colorado facing that non-renewal notice today. What is the single most urgent message?
The FAIR Plan is a critical, necessary backstop. It prevents total uninsurability, but it offers strictly basic coverage tied to actual cash value. It is a severe financial compromise. A diligent, aggressive search for full replacement cost coverage, even if it means looking at surplus lines carriers with good financial ratings, is mandatory. You have to secure that ERC and law and ordinance coverage. The FAIR Plan must be your absolute last resort.
That's the hard truth. And it's backed by that 60-day deadline rule. If you get that non-renewal notice, you have 60 days to act. Use that time to shop aggressively, to audit that premium spike, and secure the mandated coverage. And if the premium feels just excessive, before you accept it or run to the FAIR Plan, you should use the auto resources we have available. Double-check that premium, Understand your true market risk. Do not let the ARP plan's crippling ACV structure become your financial default.
And here's a final thought for you to explore. Given the financial structure, the fact that admitted carriers were forced to pay that $46.5 million assessment to fund this thing, how might that forced financial burden ultimately influence the pricing and availability of insurance in the traditional market next year?
You mean, does the cost of funding the state's safety net just become another justification?
Another justification for increased premiums and reduced risk acceptance in 2025. That is the calculus the industry is running right now.